Hi, welcome back. If you have been watching silver over the last several months, you already know something dramatic happened. The metal that everyone was celebrating at $121 an ounce has now dropped all the way down to around $56. That is a fall of more than 52% from the top, and for a lot of people holding silver, this has felt confusing, painful, and honestly a little scary. Today I want to walk you through exactly what happened, why the price fell so hard and so fast, and why a growing number of analysts believe this drop is not the end of the silver story at all. In fact, many believe this could be one of the most important setup phases before the next major move higher. So stick with me, because by the end of this video, you will have a much clearer picture of what is really going on underneath the surface of this market. Let's start with why this moment matters right now. Silver is not just a shiny metal that sits in a vault. It is one of the most industrially important materials on the planet. It goes into solar panels, electric vehicles, semiconductors, medical devices, and a huge range of electronics that power modern life. At the same time, silver has always carried a second identity as a store of value, something people turn to when they are worried about inflation, currency weakness, or economic uncertainty. When a metal with this kind of dual role suddenly loses half its price in a matter of months, it forces everyone, from casual investors to large institutions, to ask a very simple question. Did something fundamentally change about silver itself, or did something else happen in the market structure that pushed the price down without actually reflecting the real supply and demand picture on the ground? Now this is important because those two explanations lead to very different conclusions. If silver's decline was caused by a genuine collapse in demand or a flood of new supply, then the lower price would simply be the market doing its job, adjusting to new reality. But if the decline was driven mostly by trading activity in the futures market, meaning contracts and paper positions rather than actual physical metal changing hands, then the picture looks very different. Let's break this down step by step so you can see exactly how this works. Most of the price you see quoted for silver every day does not come from someone buying an actual bar or coin. It comes from the futures market, primarily through an exchange called COMEX. On COMEX, traders buy and sell contracts that represent silver, and the vast majority of these contracts are never actually settled with real metal. Think about it this way. Imagine a small town with only a few hundred actual houses, but thousands of people are trading paper certificates that claim ownership of those houses. As long as most people never ask to actually move in, the paper trading can happen at a much larger scale than the real housing supply would ever allow. That is roughly how the silver futures market functions. A relatively small physical market sits underneath an enormous layer of paper trading, and that paper layer is what sets the daily price almost everywhere in the world. This matters because when large trading firms build up big positions and then decide to unwind them quickly, whether due to margin calls, profit-taking, or shifts in broader financial conditions, the resulting wave of selling in the paper market can push the quoted price down sharply, even if nothing has changed in the physical world of mines, refineries, and industrial buyers. That is a big part of what many analysts believe happened here. After silver's dramatic run up toward $121, positioning in the futures market became extremely stretched. When that kind of extreme positioning unwinds, it tends to happen fast, and it tends to happen with force. And that is exactly the kind of move we saw as silver fell toward the $56 level. Here's what this means for the physical side of the story. While paper prices were falling hard, the actual physical market told a very different tale. Reports throughout this period pointed to continued tightness in physical silver inventories, particularly the registered stockpiles held at COMEX warehouses, which represent metal that is actually available for delivery. Industrial demand for silver has remained structurally strong, driven by the continued build-out of solar energy infrastructure, the growth of electric vehicle production, and expanding use in semiconductors and artificial intelligence-related hardware. Silver has now run at a supply deficit for several consecutive years, meaning the world is using more silver than it is mining and recycling combined. That is not a demand collapse. That is the opposite. It is a market where real-world usage keeps climbing even while the quoted price on your screen was falling. So how do you reconcile a falling price with rising physical demand and tightening supply? This is really the heart of understanding what a lot of people call a mid-cycle trap. In many past commodity cycles, especially in metals, prices do not move in a straight line even when the long-term trend is upward. Instead, you often see a powerful initial rally that attracts a wave of new buyers, followed by a sharp and painful correction that shakes out short-term traders, discourages the crowd, and resets sentiment before the next leg of the move begins. This pattern has shown up repeatedly across different markets throughout history. It is not unique to silver, and it is not evidence of anything unusual happening behind the scenes. It is simply how markets tend to behave when emotion and leverage get involved on the way up. Now let's talk about why so many investors find this phase so uncomfortable. When you watch an asset fall 52%, your instinct is to assume something is deeply wrong. News headlines tend to amplify that feeling, focusing on the scale of the drop rather than the underlying fundamentals. It is completely natural to feel uncertain here, and honestly, that uncertainty is part of what makes this stage of a cycle so difficult for most people to sit through. The investors who bought near the top are dealing with real losses on paper, and the investors sitting on the sidelines are wondering whether this is a warning sign or an opportunity. Both reactions are understandable, and neither one is unreasonable. Before we go further, if you're finding this breakdown useful, take a second to like the video and subscribe to the channel. It genuinely helps this kind of in-depth market analysis reach more people who are trying to understand what is actually happening with their money, rather than just reacting to headlines. Now let's continue. It is also worth being fair and looking at this from the other side, because a responsible breakdown should not just present one point of view. There are analysts who argue that silver's drop from 121 to 56 was simply a natural and healthy correction after an unsustainable and overheated rally. Under this view, the run-up to $121 was itself the anomaly, driven by speculative momentum and a wave of retail enthusiasm that pushed the price well beyond what fundamentals alone could justify. From this perspective, $56 is not a manufactured trap at all, but simply the market finding a more rational level after emotion drove prices too high too fast. Both explanations, the paper market pressure story and the healthy correction story, are worth holding in your mind at the same time, because markets are rarely explained by a single simple cause. Here's a simple mental framework you can use to make sense of moves like this going forward. Try separating what is happening in 3 different layers. The first layer is the physical layer, which includes actual mine production, industrial consumption, and available above-ground inventories. The second layer is the paper or futures layer, which reflects trading positioning, leverage, and short-term sentiment. The third layer is the macro layer, which includes interest rates, the strength of the dollar, and broader investor risk appetite. Big price swings usually happen when these 3 layers move out of sync with each other. When the paper layer swings far ahead of the physical layer, either to the upside or the downside, that gap tends to close over time, because eventually physical scarcity or abundance has to be reflected somewhere. Keeping these 3 layers separate in your head makes it much easier to understand why the quoted price can move so differently from what is happening in the real world of supply and demand. So what might happen from here? Nobody can predict markets with certainty, and anyone claiming otherwise should be treated with caution. That said, there are a few scenarios worth thinking through. One possibility is that the physical supply deficit continues to build. Industrial demand keeps climbing, and eventually the paper market has to catch up to that underlying tightness, which historically has been associated with sharp upward price moves once the imbalance becomes too large to ignore. Another possibility is that the correction continues for longer than people expect, testing patience even further before any meaningful recovery begins. A third scenario is a slower, choppier stabilization where price moves sideways for a while as the market digests the sharp decline and waits for clearer signals from both the physical and macro sides. Each of these paths is plausible, and the honest answer is that we simply have to watch how inventories, industrial demand, and broader monetary policy evolve over the coming months. There is another angle worth mentioning here, and that is the relationship between silver and gold during this period. Many investors watch what is called the gold-silver ratio, which simply measures how many ounces of silver it takes to buy 1 ounce of gold. When silver falls harder and faster than gold, that ratio widens, and historically wide readings in that ratio have often preceded periods where silver eventually catches up and even outperforms gold once conditions stabilize. This does not mean it will happen on any particular timeline, but it does give another data point for understanding where silver sits relative to its historical relationship with gold. Alongside this, broader macro factors continue to play a role. Decisions coming out of the Federal Reserve regarding interest rates, along with the overall strength or weakness of the dollar, tend to ripple through every corner of the metals market. When borrowing costs are high, holding a non-yielding asset like silver becomes more expensive on a relative basis, which can add extra pressure during periods when the paper market is already unwinding aggressive positioning. Global factors add another layer as well, including trade tensions between major economies and shifting policies around the export and stockpiling of critical minerals, since silver is increasingly viewed by governments as a strategically important material rather than just a traditional precious metal. Now let's connect this back to why any of this actually matters for your everyday financial life. Silver is not just an abstract commodity that traders argue about online. For many households, it represents a form of savings, a hedge against currency devaluation, or simply a piece of a diversified portfolio. Understanding the difference between paper price swings and physical market fundamentals can help you interpret headlines with a lot more clarity and a lot less panic. It can help you recognize when a dramatic price move is being driven by short-term trading behavior versus a genuine shift in real-world supply and demand. That kind of understanding does not tell you what to do with your money, but it does help you ask better questions before making decisions, which is really the whole point of following markets closely in the first place. It is also worth remembering that volatility like this is not new to precious metals. Silver has a long history of sharp rallies followed by painful corrections, stretching back decades. What makes the current period notable is the scale of the industrial demand story layered on top of the traditional store of value narrative. Solar energy alone has become a massive and growing consumer of silver, and that trend shows no signs of slowing down as more countries continue building out renewable energy infrastructure. When you combine that structural industrial pull with silver's traditional role during periods of economic uncertainty, you get a metal with two very different sources of demand pulling in the same direction over the long run, even while short-term price action can look chaotic and disconnected from those fundamentals. Let's bring this all together. Silver fell more than 52% from its peak near $121 down to around $56, and that kind of move naturally shakes confidence and raises questions. A large part of that decline appears to be tied to activity in the futures and paper trading markets, where positioning had become extremely stretched after the earlier rally. At the same time, the physical side of the market, including industrial usage and available inventories, has continued to show signs of real tightness rather than weakening demand. Whether you view this as a manufactured trap during a longer-term bull cycle or simply a healthy and overdue correction after an overheated rally, the underlying lesson is the same. Pay attention to the physical fundamentals, stay aware of how paper markets can create short-term price distortions, and try to think in cycles rather than in single dramatic headlines. Markets rarely move in straight lines, and understanding that can make a real difference in how you interpret moments like this one. That's it for today's breakdown. As always, none of this is financial advice, just an attempt to help you understand what is actually happening beneath the surface of a very confusing price move. If you found this helpful, consider subscribing so you don't miss the next video, where we'll keep digging into what's shaping the metals markets heading through the rest of 2026. Thanks for watching, and I'll see you in the next one.